Yeah, I'm Chris Hill, joined by Abby Mallon and Ron Gross. Thanks for being here.
Always a pleasure, Chris.
We're talking dividends. We're going to be taking your questions, and if you want even more information on the stocks that will pay you, good news. You can go to fool.com/payme. We've got our free dividend investing playbook for 2020. Again, that's fool.com/payme. Check it out when you get a chance. Ron Gross, let me start with you.
Yeah.
Dividend stocks, what's attractive about them other than the obvious reason, which is it's a stock that pays you money?
Well, that was going to be my first answer right off the bat. Certainly dividend stocks are income stream that dividends can offer, but they're also good for investors that are looking for more mature companies, those that have the proven ability to generate cash flow and have disciplined management teams with strong capital allocation skills. Those types of companies often do quite well in the stock market. Those are the kind of companies you often want to invest in, perhaps not as sexy as some of the growth names, but really well-run companies.
Abby, I don't want to come off like I'm turning down money from a company that's looking to give me money for stocks that I own, but why do companies pay dividends in the first place?
So when companies have earnings, they really have three options. The first is that they can retain those earnings for reinvestment. So this is what you see with typical growth stage companies. The second is that they can do share buybacks. So this is advantageous for management teams to execute when stock prices are particularly low or there's a lot of dilution coming to the market. And the third option is paying dividends. So this really rewards your shareholders for being patient and invested in the company.
And I was going to say, when companies discover that they are generating enough cash on an annual basis to support the business and to invest in growth, if they have growth opportunities, when there's enough of that and then there's excess, the excess often is returned to shareholders. You actually, as a shareholder, wouldn't want it to be returned to you if the company had exciting reinvestment opportunities for growth. But when they don't, solid, sound management will then return it to shareholders.
Let's get to investors for a second, because you think about the companies that pay dividends, and you can go back 8, 10 years. One of the big questions about Apple was, my gosh, they have all this cash on the balance sheet. Are they ever going to pay a dividend? There was a point in time where there was almost a stigma attached to companies. I mean, you used the word sexy. There was that pretty long stretch of time where if you paid a dividend, it was like you had crossed the Rubicon. No longer you were a growth company. Now we're putting you in this separate category. In terms of investors, though, who do dividend stocks make sense for? Because it would seem on the surface, if history's any judge, it's maybe investors who are a little bit more conservative.
I think that's true, but what we have to remember is it's, no matter what, it's a total return game. Okay, you're investing for income if you want it, but what really matters is the total return that the stock is going to provide. And total return is defined as the dividend yield plus, hopefully, the stock appreciation. And it would do you no good to invest in a 4% yielding stock, but then have that stock pull back and actually make you lose money. So let's never forget that total return is always the name of the game. And as you said, these are more stable companies. They're typically growing, like Apple is a growing company, but Apple is not growing 20, 30, 40% a year. It's a huge company that generates gobs and gobs of cash flow, but at a slower rate, and they have enough to spread it around to shareholders as well.
Abby, to go back to the capital allocation that you were talking about before, it does seem like dividend payments can be one more way for us as investors to figure out how good is the management team here, because it's one thing to start paying a dividend and make that decision. It's another thing to be so smart in your capital allocation that you can sustain that over time.
Right. I mean, I think sustainable dividends is really the name of the game. Anytime you see a company sort of slash a dividend or skip a dividend, it's always very, very negative news, because a lot of these companies are held in funds that have minimum requirements on dividend payments and dividend yields and things like that. So that is true. Sustainability is super important. And I think it's why you've seen a shift towards people paying special dividends as opposed to necessarily timed dividends. So you don't set up the expectation, but when the funds are there, they do pay them out.
You know, it's interesting. Sometimes companies that should stop paying a dividend don't, just because of what you said. It's seen as such a negative. But sometimes it's actually the right decision to do, whether the company needs to retain some cash for growth, or maybe the company isn't doing as well and the balance sheet starts to get into a little bit of jeopardy. And a really strong manager with confidence in capital allocation will make that tough decision and not worry too much about the market punishing the stock.
All right, let's get to some of the metrics that investors should be looking at. And And right off the bat, when you're thinking about dividends, yield is absolutely a metric to look at, to evaluate, along with payout ratio.
For sure. Yield, simple math, is the amount of stock, let's say, in the amount of dividends in a given year divided by the stock price. That's the yield. The yield on the S&P 500 right now, for example, is about 1.8%. The payout ratio is the percent of a company's earnings that it chooses to pay out to investors. The lower that payout ratio, the safer the dividend is. If you start to pay out 80, 90, 100% of your earnings, it gets very dicey if those earnings come down and you can no longer support the dividend. So be careful if companies have payout ratios of, let's call it 75% plus.
Well, and to go back to management, Abby, you look at the dividend history. I mean, that's one more way to figure out not only what should I expect as an investor, but how good is this management team?
Right, it's all about sustainability. So the more consistent and the more, particularly companies that are able to increase their dividend pretty consistently over time, is typically a very good sign for management.
You know, it's interesting. Over the past about 80 years, dividends have accounted for about 40% of the total returns of the S&P 500. And they're, in certain circumstances, in many circumstances, a very predictable return, whereas the stock itself, you don't know really what it's going to do in a given year. But you typically do know if a solid, strong company is going to pay out that 2%, that 3%, the 4% a year. So it's a predictable return that you can earn, and then hopefully the appreciation goes on top of that for the total return we talked about.
All right, I know you both have a couple of stocks. We'll get to those in a second, but first, Ron, let me start with you. Just as there are dividend do's, there are absolutely dividend don'ts. And it seems like chasing yield is one of those. It's a mistake that a lot of investors have made. It's understandable, but it's still a mistake.
It is a mistake, but it's awfully tempting when you see a nice juicy yield of 8% and you go, boy, that sounds wonderful. But it's often an indicator that something troubling is happening with the company, because don't forget, the formula is dividends divided by share price. And if that share price has plummeted, the dividend yield goes up. It's just the way the math works. So you want to understand why a company's dividend yield is very high. Now, if it's a real estate investment trust or a master limited partnership, that might be a good reason for a dividend to be higher, because those types of companies have the certain structures that allow them to pay higher dividends. But you always kind of want to look under the hood to understand why.
Well, and that's the thing. If you're just screening for yield, Abby, I mean, you're more likely to come up with those MLPs, those REITs. And if you're a newbie investor, you may not understand the underlying risks of investments like that versus basic stock in a company.
Right. I mean, I think one of the main risks to bring up here is, well, it's actually twofold. The first is taxes. Your taxes get much, much, much more complicated when you invest in structures like that. And the second is, typically those have limited growth opportunities. So you're not going to see the same sort of growth expectations in the share price that you would with like more normal public equities.
Yeah, I'm sorry, I was just going to say, a good example is a real estate investment trust by law has to pay out 90% of its earnings. But the other side of that coin is that they don't have any retained earnings. So if they need money for growth to buy more properties, they've got to go back to the marketplace, to the capital markets, and sell stock, causing dilution and this virtuous cycle of we need money, we sell stock, we need money, we sell stock. But on the other hand, the dividend yields are typically higher.
All right, we're going to get to your questions in just one moment, but first, two stocks to add to your watch list. Dividend payers, of course. Ron Gross, what do you got?
I'm going to go with Hasbro, HAS, one of the largest makers of toys and games, obviously. Weaker than expected third quarter results really took a whack out of the stock, mostly concerns over tariffs. And it's actually giving investors, I think, a good opportunity to get in at a nice price. They've got a nice combination between toys, branded entertainment, their digital offerings are doing well. Dividends. They've raised their dividend consecutively for the past 16 years. The yield currently stands at 2.6%, and it's a little higher than normal, and that's because, again, that stock price dropped.
16 years in a row, 9 more years, they get the dividend aristocrat status. Always interesting to see who makes that list. Companies that have paid a dividend for 25 years in a row, increased it 25 years in a row. Abby Mallon, what do you got?
I would bring up TJX companies, so ticker is TJX, and they are a leading off-price apparel and home fashions retailer in the US and worldwide. So they have more than 4,300 stores across 9 countries. And it includes TJ Maxx, Marshalls, HomeGoods, Sierra, and HomeSense. So I think there's really 3 reasons to like this company. The first is that I think they have sustainable barriers to entry. Their inventory management and inventory sourcing is truly top-notch. They're a consistent performer, which has led to consistent market share gains and stock price appreciation. So same-store sales growth has increased every year over the past 10 years, typically between 2 and 7%, which is pretty high for a retailer, particularly considering the economics of retail that we've seen over the past 10 years. Their inventory turnover is always top-notch and well ahead of comps. In the past 12 months, it was over 6x, which is very high for a retailer. And their dividend has consistently grown, typically at more than 20% for the past 10 years as well. And then the last reason I like it is sort of, I think TJ Maxx provides a good rounding for dividend stocks because it's also a growth stock. They are still seeing growth within their top line and bottom line. So it's not as consistent. It will be a little bit more volatile than a typical dividend payer, but one that's super interesting.
We were talking before about MLPs and REITs. Let's put those aside for a second. What about a company like General Motors, a very well-known company, stable company? That's a stock where the dividend yield is closing in on 5%. What makes something like TJX, in your mind, a better dividend stock than a company like General Motors?
Yeah, that's a good question. I mean, I think it's because dividend yield is a function of share price. And with TJ Maxx, you are seeing sort of an elevated share price given that people are pricing in and expecting for growth. And I do think that growth is achievable, but it's going to, in the short term, sort of suppress that yield.
And I think you always have to go back to total return. I think TJX is a better total return opportunity, despite the fact that it has a lower dividend than a company like GM.
All right, we're going to get to your questions. If you're enjoying the video, please consider giving us a thumbs up. We always appreciate that. It helps other people find the video as well. And again, if you want our dividend investing playbook for 2020, it's free. Just go to fool.com/payme and it's yours. Let's get to the questions that are coming in. First from Joel, who asks, are there any dividend ETFs or mutual funds that you would recommend?
That's an interesting question. I don't know any off the top of my head other than the typical Standard & Poor's 500, which would be the Spiders SPY, for example, which is filled with all the dividend aristocrats by definition. As I said, that's about probably a 1.8% yield right now, which is a little bit lower than history, than the historical rate because the stock market has been on fire so much. So the stock prices go up, the yield goes down. I'm sure there are dividend-specific funds, but I don't have any specifically to recommend.
Sandeep asks, when looking for high yields, Shoppingmall REITs show up as prime candidates. How safe do you think the dividends are from the high quality malls like Simon? It's interesting. It's an interesting question in part because Sandeep breaks out, the fact that, look, not all malls are alike. I know it's been a rough decade or so for bricks and mortar companies, but there are certainly different tiers to malls, some doing better than others.
Yep, and this is one where you want to make sure you're not chasing yield and you're kind of looking under the hood and kicking the tires to understand what you're buying. Are they focused on the A malls or the B or the C malls, which are struggling more? Obviously, malls in general are struggling. REITs have been volatile, but in 2019 were really strong performers. Just understand what you're buying. I think Simon Property probably is a good one to own. Some others I would be a little bit more wary of.
Yeah, I would suggest just making sure you're looking at those occupancy occupancy rates and sustainability of the sort of stores that are really anchoring those malls in particular.
Well, it's a great point, especially when you consider we've seen lots of headlines over the last few years of well-known retailers that are closing dozens, if not hundreds of locations. What doesn't get as much attention is who's coming in to fill that.
Right.
So you can see the news about a Toys R Us bankruptcy or that sort of thing, but
right.
Then there are others that come in and sort of fill that gap.
I'll add one real good metric for a real estate investment trust that you should focus on is funds from operations. It's their accounting version of earnings or cash flow. Take a look. How is that trending, especially over the last couple of years?
We got a few people who are asking, how do you best compare dividend payers across different industries so that it's more of an apples to apples comparison? I mean, we were talking before about GM and TJ Maxx. Both pretty well-known brands, obviously very different businesses,
right.
making automobiles versus fashion retail?
I don't know that I would necessarily try to compare those companies in that way. I think there's more to look at than just dividend yields. I think you want to look at, again, total returns, the overall company. As with any portfolio, you want to be diversified across industries, across sectors. So I think there is a place for multiple dividend payers in any portfolio, but I don't necessarily know that I would make a dividend segment and just allocate in that manner.
I agree with that. One thing to be careful of is that there are certain sectors that typically pay a dividend: energy, utilities, financials. If you focus too much on those because you're looking for yield, you'll find all of a sudden that you don't have a diversified portfolio. So you want to just be wary of that.
And with that being said, you would have severely underperformed because a lot of tech companies aren't yet profitable, let alone paying dividends. So you would miss out on a lot of growth that we've seen in the past.
Speaking of energy, a question from Thunder Crow. Yes, Thunder Crow, thank you.
I like it.
Are midstream companies like Hess and BP a dividend trap? I love the question because a lot of times when we're looking at dividend stocks that are falling for one reason or another, it really does come down to that question of, is this a value play or a value trap, a dividend play or a trap?
And, right, and it's really the same question, and you've got to take it on a case-by-case basis. Certainly there are certain industries that come in and out of favor, that we don't like the business models of, that we would stay away pretty much perpetually, but other ones that are cyclical and go in and out. In this case of midstream, I would look at individual companies before I really made an assessment and stayed away from the entire sector of the energy industry. But for the most part, I would be wary because companies in that sector are ripe for things like dividend cuts or slowing dividend growth.
Walter asks, I reinvest my dividends on all of my holdings. When I feel a stock is overpriced, should I continue to reinvest or take the cash for other investments? Again, it's nice to get the cash, but for a lot of investors, Abby, it really seems like the best move is just to check the box, put that right back into more shares.
Yeah, I would say typically I think the best move is always to reinvest them, but when you start to wonder if maybe a stock's getting a little bit overvalued, that could be a good time to start just building a little bit of cash, setting it aside. You always want to look at what your other opportunities are. So if you have things that are on your watch list that are interesting, that may or may not be a dividend player, that might be a good time to sort of stop reinvesting.
Yeah, I think that's right. If you're sophisticated enough to the point of where you have an opinion about value and say that you want to stop accumulating a specific stock because it's getting pricey, then yes, I would say take the dividends in cash. It requires a lot of work across a lot of companies if you're going to really be focused. And a value investor answer would be, if you don't want to buy more through dividend reinvestments, maybe you actually don't want to own that stock at all anymore if you think the value has run its course.
Milton asks, are there any obvious warning signs that can help investors avoid catastrophes like General Electric? We were talking earlier about companies cutting their dividend, and it can be the right move. Maybe it was the right move for GE over the last 18 months to cut their dividend, and then I'm pretty sure they cut it all together. Were there obvious warning signs at the time?
Yes. There typically are warning signs. It never happens, almost never happens just all of a sudden. You see a company start to struggle. You'll see a company start to restructure. You'll see earnings either decrease or go negative, and this company will start to lose money. The dividend yield will be really high because the stock price is really low. The payout ratio will be unsustainably high because they're paying out too high a portion of their earnings. So all these red flags are there to, the writing is on the wall.
I would just add, I think whenever you bring in a new management team, in a negative situation, I think typically everything is on the table for reconsideration. And so that's also a time when you would see or likely be warned that there may or may not be a change to that dividend.
Michael asks, I know nothing about investing and I'm kind of fearful about doing the wrong thing, but since I have a nice amount to invest, how can I get started? Well, first of all, congrats to Michael to getting started in the first place, because a lot of times the first step can be a little scary, but it's always great to take that first step.
And it's great that he has a lot of money to get it done. So I would start with a S&P 500 index fund to get yourself some instant diversification, and then slowly over time, no need to rush here, but methodically start to invest in some of the companies that you admire most, that you think are well run, perhaps companies whose products or services that you use, and slowly over time you'll build yourself up a nice portfolio, but do it consistently. Don't do it in fits and starts. Be a consistent investor over time.
Yeah, and I would just add that Abby and Ron offered up a couple of stocks for your watch list. You can get 3 more by getting our dividend investing playbook for 2020. It's free. Fool.com/payme. Wes asks, what do you think about tech stocks that pay dividends like Apple, Microsoft, and Texas Instruments? Seems like they have decent yields and some growth potential. Well, as you mentioned earlier, Apple's certainly a growth stock still.
Yeah, these tech stocks that pay dividends are typically the ones that are lower growth, but there's nothing wrong with that. It's just something you need to understand. Microsoft and Apple are the two of the best performing stocks of 2019, and they're not these nimble, early stage, small cap growth companies. They're just amazing generators of cash, and they generate so much cash that they're happy to return some to shareholders. You know more about tech than I do, though.
Yeah, I mean, I think in tech, we've seen a shift towards favoring sort of these very early stage, often unprofitable, particularly SaaS companies, because software as a service companies, because they tend to operate with really high margins. I think any company that you see in a more mature phase where they have sort of an established market share and it's really theirs to defend, where you have this much cash in the books, they don't necessarily need to retain all those earnings to continue to grow. And so I think those can be really attractive investments. With that being said, I think everyone in the market sort of recognizes that these are very attractive investments, and so you're going to always see sort of premium pricing on them, but as a part of a portfolio, I think it's strategic.
T.O. asks, what do you think about the banking sector for dividends, like perhaps Bank of America or J.P. Morgan Chase?
For me, I've never been a big individual financial stock investor because I'm afraid of not knowing what I don't know. The balance sheets are always very convoluted and it's hard to understand exactly what's going on. However, there are great stocks like JP Morgan out there run by great leaders like Jamie Dimon. I prefer to participate through ETFs when I invest in sectors that perhaps I'm not smart enough to understand companies on an individual basis. So for financials, that's particularly what I do.
I would second that answer.
X asks, what do you think about tobacco companies? Altria and PMI, the dividends are high and they have been paying dividends for ages. Absolutely right. I mean, when you look at the list of dividend aristocrats, Altria, formerly Philip Morris, I don't know if it's number 1 on that list, but it's way up there. I think they've been increasing their dividend every year for somewhere in the neighborhood of 55, 60 years.
Yeah, this is a tough one for me, and it's partly ethical, morality based. So to each his own, whether you want to be invested in a sector like tobacco, and I won't pretend to know for everyone. Obviously, these companies generate gobs of cash flow. They're undergoing a lot of change, whether it's regulatory or new products coming online, and now you have all the vaping and the Juul problems with more litigation. So it's an evolving industry that continues, even though smoking and tobacco use is way down here in the U.S., it continues to produce, as far as I know, significant levels of cash flow that can support that dividend. Not for me personally.
Yeah, I would just say that stock price is certainly risk adjusted. So Ron mentioned this, but obviously the legislation around tobacco and particularly vaping right now is really shifting and changing and evolving. And so those stock prices have been hit as a result of really an unclear path forward as regards to legislation. So just be a little bit wary, perhaps.
A few different viewers are asking, are there any sectors that you are totally staying away from? I like that because it's pretty open-ended, because let's face it, there can be industries that we stay away from because we feel like that's not really in our circle of competence. You touched on banking in terms of individual stocks. But certainly we're in year 11 of a bull market, and there may be some industries or sectors that you're staying away from just because it's getting a little too crazy in terms of the pricing.
I would never be a market timer in that sense. And I'm very young, so I have enough time to sort of ride these waves up and down. So I typically don't invest based on expectations of timing. With that being said, I do own quite a few mutual funds. And so I think, obviously I have exposure to everything. And then the third layer of that is I tend to not look so much at energy because I feel like it's a little bit just generally less interesting and a little bit more volatile and unpredictable from my perspective as an analyst. And The other one I tend to not really look at too much is utilities, just because they are so predictable. It's very challenging to see significant stock price appreciation.
Yeah, I've stayed away traditionally from industries that I don't understand well, financials being one, but biotech being another one. Now, I changed that in 2018, 2019, because I recognized certain sectors that I really wanted to be involved in, because I think they're going to change the future of medicine. But I did it in a basket approach. I bought 8 companies in the gene therapy sector, for example. So I would spread my risk, understanding that there's no way, with my knowledge base, I could properly analyze those companies. So that was kind of a shift for me.
Melody asks, many of the stocks you recommend are several hundreds of dollars for one share. Is it worth it to purchase just 10 to 20 shares? Well, I think Melanie has inadvertently touched on what's exciting about penny stocks. Because with penny stocks, you can get a whole lot of shares right off the bat. But I think the obvious short answer is yes. I mean, if it's a good company, then it's absolutely worth it. Maybe not as fun to own just a few shares, but worth it.
Yeah, the important thing to really remember is the number of shares, honestly, is irrelevant. It's the amount of capital you put into an investment. The shares, it honestly, in no way does it matter. Now, some share companies are so high in price that you don't even have enough money to buy one share, and that has typically been a problem. Now, they have a lot of brokerages introducing fractional share purchasing, which allows you to buy a fraction of a company, and that's wonderful. And again, all that matters is the amount of cash you're putting into the investment, not the number of shares.
Yeah, I would encourage her to look at the full market cap of a company relative to the total addressable market that they're entering, and sort of think about whether it seems expensive or not relative to the market. And the second thing I would add, actually, when you look at the data, more expensive companies on a per share basis, so if it's hundreds of dollars or more even, they tend to be less volatile on a daily trading volume, just because you don't have people trading in and out quite as easily because it's at such a higher level. So if anything, I would say it's probably can be a positive indicator, actually.
Scorp asks, what do you think of investing in dividend stocks on loan using margin accounts?
Oh, Scorp. I would, unless you're very sophisticated, I would recommend never using margin. I would never borrow money to buy stocks. It's a slippery slope into getting yourself into lots of trouble, especially in a downturn or a market crash or a correction. I don't think it's worth it to introduce that leverage into your portfolio. I don't know if you...
I would second that answer as well.
Jim asks, I'm worried about investing at the height of the bull market. Do your recommendations consider the current market conditions? I'm assuming they do.
They don't expressly. I'm more of an individual stock investor, and so one stock at a time, is it a good investment or is it not? It's hard to be a market timer when looking at the market as a whole. If you're constantly looking at companies and you can't find any that look attractive, then that's an indication that the market as a whole is trouble. But still, I think what you want to do is just be a consistent investor. So that means you'll be putting money into the market when it's high. You'll be putting money in the market when it's low. You'll be putting money into the market year after year after year. And 20, 30, 40 years down the road, it really won't matter whether the market was high in the year 2020.
Yeah, I would just add, I think if you took that sort of market timing, maybe more hesitant approach, I mean, markets are predictable cycles, but with that being said, we're 11 years into a bull market, and typically we have pretty major setbacks every 7 years. So we are well overdue, and if you had taken that approach, you would have missed out on a lot of gains. So I think it's more important to be consistent investing at all times and maybe be a little bit more scrutinizing about the types of companies that you're putting money into rather than whether or not you're actually investing.
All right, Abby Mallon, Ron Gross, thanks for being here.
Thank you,
Thanks
Chris.
for having us.
Thanks everyone for watching. Thanks for giving us a thumbs up. It really does help other people find the video. And again, check out our free dividend investing playbook for 2020. You can go to fool.com/payme for all the details. I'm Chris Hill. Thanks again for watching. We'll see you next time.